Hello, welcome to the weekly economic snapshot. The dollar has been getting some attention recently because, after appreciating last fall, in 2025 it has been losing value relative to other currencies, and the decline accelerated in April. This has come as a bit of a surprise given recent trade policy announcements. Normally, tariffs imposed by the US would cause the dollar to appreciate. If Americans had less demand for imports due to tariffs, fewer dollars would be sold in the foreign exchange market. Also, normally during times of global economic uncertainty, the dollar acts as a safe haven as investors buy dollars and park them in US Treasury bonds to wait out the storm. The recent moves have raised the question, is the dollar losing its special status, and what does this mean for the United States? The dollar is the predominant global reserve currency, which is held by many foreign governments, and US Treasury bonds serve as a global safe asset, widely held by investors, governments, and financial institutions around the world. This serves to make the value of the dollar somewhat higher, which makes US exports more expensive and imports less expensive. The financial flows into the US reduce our long-term interest rates. So one concern is that this contributes to the US trade deficit. The word deficit implies that it's a bad thing, but that is not entirely the case. If the US is importing more than it is exporting, we're getting more stuff than we're sending out. Our trading partners are receiving financial assets, stocks, bonds, and other claims on the United States in return. The current account is a measure of international payments that is mainly driven by the trade deficit, but also includes earnings on foreign assets and transfers like remittances sent by immigrants to families in their home countries. The US current account deficits over the years show that we are a large net borrower. At the end of 2024, the US, and this is the US economy overall, not just the government, had external liabilities of $62.1 trillion and external assets of $35.9 trillion. The gap between those numbers implies a net debt of $26.2 trillion. That sounds really bad, but here's where we see a benefit of the dollar's special role. It means that a large share of US liabilities are in low-yielding US Treasury securities, while US external assets include a higher share of equity, which earns higher returns. In 2024, US income from foreign assets was $1.435 trillion, while we paid out $1.444 trillion, a difference of only $9 billion. So the burden of that large net debt was actually pretty small. And 2024 was a bit of an exception. In most years, the US has actually received more in income from external assets than it has paid on external liabilities. Thanks for watching. We'll see you next week.